Whenever you're borrowing money for housing or for a business purpose, you'll be asked whether you want your loan to be fixed or variable. Understanding the difference between them is essential for making an informed decision that aligns with your financial goals and circumstances. Hi, I'm Jordan from Outway. I've been a broker and commercial banker for over 15 years, and as a home and business owner myself, I know how stressful it can be to make the right choice for any kind of loan, especially something as important as a mortgage. To help you make an informed decision, I'll be breaking down the difference between variable and fixed interest rates and some common reasons why you might choose one or the other when seeking a home loan. So to start, what do these terms actually mean? Put simply, variable interest rates means your mortgage payments will increase or decrease in response to changes in the Reserve Bank's official cash rate. As interest rates go up and down, your payments will too. With a fixed interest rate, you can lock in a set rate for a fixed period of time, so your mortgage payments remain consistent no matter what's happening in the economy. Let's dig into this a little deeper. It might come as some surprise that while you are borrowing money from your bank, it is in fact borrowing money from other sources to fund your loan. A major source of funding for Australian banks is the Reserve Bank of Australia. Every month, the Reserve Bank decides whether to increase, decrease, or keep steady its cash rate, which is the price it charges your bank for loans made to it. If you have a variable loan, then usually your bank will pass on some or all of that increase or decrease in cost from the Reserve Bank. As a result, a variable rate loan will generally move in sync with the Reserve Bank cash rate. But there are many exceptions. Banks are at liberty to set their variable rates in any way they deem appropriate and at any time. In practice, any change in your variable interest rate, which is out of sync with the cash rate, is driven by business requirements. And read into that to mean their need to make a profit. Competition is also a factor. For example, if a bank is feeling like it has enough home loans on its books and therefore is not needing to compete hard, it may increase its rates by more than what the cash rate has increased. Or it might even increase rates when the cash rate has remained steady. Many banks notoriously undertook this practice during the global financial crisis in 2008. So the primary drawback of a variable interest rate is uncertainty. Since your repayments can fluctuate, it can be challenging to budget accurately over the long term. Variable rates can both decrease or increase, but increases will leave you with higher mortgage repayments and increased financial strain. Even worse, depending on how you're wired, copying a higher rate can leave you envious and resentful of your smug friend who proudly boasts of the hot, low, fixed rate they secured right before the Reserve Bank started hiking their cash rate. But for the cost of that uncertainty, you do acquire two major benefits: flexibility and offset. Flexibility means being able to do anything with your loan or indeed your property at any time. If your lender turns out to have awful customer service, you can easily refinance. If your lender is hiking its variable rate, but another lender is still offering sharp rates, refinance. If you want to renovate, or your working situation changes, or you want to change anything to do with your loan approval, such as moving on to interest-only repayments, a variable rate means you can approach any lender to get it done rather than be stuck with the one you have. And if you spot an opportunity to sell for profit or cash out for a dream property, you can sell the property and repay the debt with no penalty. On top of all of that, if you're diligent and tucking away more each month than the minimum required repayment, then on many variable loans, those surplus funds can go into offset, where they'll reduce your interest costs and in many cases take years off your loan. So, fixed rates. This is where you set a rate with your lender, typically for a period of 1 to 5 years, and that rate is contracted to stay the same for the fixed term, regardless of changes in the cash rate or competitive pressures on your bank or their business strategy. This makes predictability one of the main benefits of a fixed interest rates, as you can budget more effectively when you know exactly how much you'll need to repay each month over the fixed period. This can be especially helpful for first-time home buyers, anyone on a tight budget, or those with a fixed income. It is also recommended for people who are risk averse generally, or who have only a thin financial buffer, also known as a rainy day fund, to deal with unforeseen financial pressures. Finally, many investors find fixed rates attractive for various reasons I will cover in another video. However, like everything, there are also some downsides to choosing a fixed interest rate. First, often you'll likely find that fixed interest rates start higher than variable rates as you pay a premium for the added stability. Also, if the general consensus in the economy is that the Reserve Bank is in a cycle of increasing its cash rate, the fixed rates on offer reflect this expectation. If you take a 2-year fixed rate, your rate reflects where the banking market expects the cash rate to land on average over the next 2 years. In practice, what this means is that many people will opt for a fixed rate when they feel a little threatened about the immediate future of the economy. The problem is that if you are feeling threatened, the banking market has most certainly already read the economy and has considered a rising cash rate to be very likely. Therefore, the fixed rates on offer will already be well above the current variable rates. Unfortunately, many people fix their rates after the news of rising cash rates is out of the bag, and they end up fixing at a level well above what they would pay if they were on a variable rate. If you're on a variable rate, you can in fact absorb rate hikes much higher than the fixed rates on offer and still come out with the same overall interest rate cost over the fixed period. That is to say, the average of a rising variable rate might in fact be the same or lower than the fixed rates on offer. Fixed rates are therefore not a guarantee that you will pay less, but by far the biggest drawback to fixed rates is inflexibility, which comes in the form of limited or no access to interest offset features, meaning you have no mechanism to reduce your interest cost if you are making more than the minimum required repayment. 2, having to pay a break fee if for whatever reason you need to repay early, vary or cancel your loan during the fixed period. So if your lender turns out to have awful customer service, you can refinance, but at the cost of the break fee. If you want to renovate, or your working situation changes, or you want to change anything to do with your loan approval, such as moving on to interest-only repayments, you can, but at the cost of a break fee. Unfortunately, a change in circumstances can even mean divorce, which leads to the forced sale of an asset. The break fee that applies in those circumstances is like insult to injury. The break fee differs between banks and is often influenced by the time left on the fixed term and the way variable rates have moved after you have fixed your loan. The best situation for reducing your break fee is to wait until very late in your fixed term or when variable rates haven't changed much since you locked in. If your head is spinning with all of the considerations, please know that this is natural. How the heck is a humble little homeowner or business owner supposed to be across the banking market's expectations of future cash rates movements, and how the heck are you supposed to know whether you'll need to refinance, restructure, or otherwise change your loan in the next 1 to 5 years? When deciding between fixed and variable interest rates for your home loan, it's essential to weigh up your individual circumstances, risk tolerance, and long-term financial goals. Wow, that sounds so generic, but hear me out. Like it or not, you gamble whether you take a variable rate or a fixed rate. With a variable rate, you are gambling that interest rates will not increase. And for the risk associated with that gamble, your reward is being able to participate in interest rate decreases. All of that is taken off the table with a fixed rate. No upside or downside, but you are still gambling because you're betting on rates going up and you are therefore buying a protection from that. Don't get hung up on trying to know which way rates will go. That's the ego speaking. And be it known that hundreds of prominent economists on TV and working within banks are frequently wrong about their predictions on the future of the cash rate, sometimes massively. The decision to go fixed or variable should rather be based on whether you can tolerate the particular pros and cons that potentially come with either choice. If you choose variable, do you have buffer in your budget? Do you have a rainy day fund? And is the risk of your rising costs and your own anxiety worth the benefit of offsetting interest and being able to change your lending arrangements easily and with little cost? If you choose fixed, are you comfortable with this asset and with this loan for the next 1 to 5 years? Can you accept that you may actually pay more interest over the life of the fixed loan than if you stayed on variable? And Is the comfort of this stability worth more to you than the increased costs that come to break fees and being unable to offset interest? I hope that my rant demonstrates that there isn't an answer to that question which is true for everybody. And besides, there are ways to hedge your bets, if you like. It is possible with many lenders to split your loan up into several parts, including a variable component and components allocated as 1, 2, 3 and 5 year fixed. That would essentially play the field. And a really important consideration to layer over that kind of structure is that your cheapest bank isn't usually the cheapest in all categories. The best variable rate lender may in fact be pretty poor with their fixed rates. And what about the best fixed rate? When that rate expires, is your bank competitive on their variable rate? This is where we do our best work. We're not mortgage brokers, we're lending advisors. How you structure your loan and the peace of mind you get from considering these angles are just as important as getting the approval, which incidentally we consider ourselves to be rock stars at. Tell me more is one of our favourite questions as it helps us understand much more about your individual circumstances, risk tolerance and long-term financial goals. So we can get this stuff right, deliver your bespoke loan. Not so boring and generic now, right? Get in touch with us now using the link in the description below and we can start the journey. Till next time, ciao.